The closing bell has echoed across lower Manhattan, and, well, the dust is finally settling on what was just an incredibly volatile Tuesday.
Yeah, a completely split personality trading session today.
Exactly. Welcome to the Bulls, Bears, and the Bell podcast. Today is Tuesday, August 11th, 2026, and it's currently 5:32 p.m. in the East. We are diving deep into the post-market action today, and our mission for this deep dive is really to figure out how we just witnessed two totally contradictory markets in the span of, like, a few hours.
Right, because if you look at the regular daytime session, it was defined by this paralyzing macroeconomic fear.
Yeah, the daytime jitters were real, but then the after-hour session just erupted into this massive artificial intelligence spending frenzy.
It really forces you to completely reevaluate the traditional mechanics of how Wall Street digests risk right now.
For sure. So let's set the scene for you first. During the regular session today, the major indices just quietly slipped backward, stepping further away from the all-time highs we saw just last Friday.
It was a defensive holding pattern across the board.
Yeah, it was. The S&P 500 closed down 0.3% at 7,728.20. The Dow also dropped 0.3% to 53,791.85.
And the Nasdaq took the biggest hit, right?
Exactly. The Nasdaq was down 0.6% to 26,445.45. Meanwhile, the 10-year Treasury yield basically flatlined, sitting unchanged at 4.69%.
Which tells you portfolio managers were essentially, putting their books in the freezer.
Right, and we know exactly what they're freezing their portfolios for. It's the July CPI report hitting the tape tomorrow morning at 8:30 a.m.
But it's not just your run-of-the-mill inflation anxiety this time around.
No, it's really not. Traders are terrified of the components in this specific CPI print because of that dismal jobs data we got last Friday. There's this overarching fear that headline inflation is going to just stay sticky at 3.4%.
Which leaves the Fed in a totally precarious position. Because if you look at why inflation might stay stuck at 3.4%, it's driven by factors the central bank literally cannot control.
Geopolitics, right?
Exactly. The ongoing U.S. and Iran conflict in the Strait of Hormuz is just wreaking havoc on supply chains. I mean, we saw Brent crude jump 1.4% today to $88.91 a barrel.
And let's break that down for the listeners for a second. It's like tapping the brakes before a blind curve. If inflation was being driven by consumers just, recklessly maxing out credit cards to buy TVs, the Fed could hike interest rates to cool that demand.
Right, standard monetary policy.
Exactly. But you cannot hike interest rates to clear a blockaded shipping lane in the Middle East.
Sure.
It just does absolutely nothing to lower the cost of crude oil when the constraint is geopolitical.
And that's the core of the dilemma. It's the difference between demand pull inflation, which the Fed can totally fight, and cost push inflation, which they can't. When crude approaches $90, the input costs for literally everything go up. Manufacturing, logistics, airline fuel, it all gets more expensive. So tomorrow's CPI is likely going to reflect those elevated energy inputs.
Which creates this absolute tightening vice for the Fed. On one side, you have Friday's jobs data screaming that the labor market is cooling and desperately needs rate cuts.
Yeah.
But on the other side, tomorrow's CPI might show oil-driven inflation screaming that they have to hold rates higher for longer. So how did traders react to that vice today?
By fleeing the risk-heavy names. I mean, they actively reorganized their sector weightings to survive potential stagflation.
Stagflation being slow growth but high prices.
Exactly. We saw communication services take a massive hit today, down 2.12%.
Right down by the Magnificent Seven, right?
Yeah, specifically Alphabet, ticker GOOGL, which dropped 3.84%. It was classic profit-taking. Managers looking at Alphabet's incredible run and deciding to liquidate to build a cash buffer before the CPI event.
But the wild part is where that liquidated capital actually went. It flowed straight into utilities, which were the star of the day, up 1.1%.
Right. Investors rotated into defensive dividend-paying names like Constellation Energy and Duke Energy.
Which is so ironic, isn't it?
Yeah.
I mean, utilities are usually considered these boring safe havens you hide in during uncertainty.
Historically, yes.
But looking at the sources, I think treating this just as a traditional defensive play completely misses the bigger picture. Next-generation AI data centers are essentially heavy industrial plants. Structurally, they behave more like digital aluminum smelters, taking massive amounts of raw electricity and turning it into artificial intelligence.
I love that analogy because smelting aluminum is incredibly power intensive.
Right. So are traders buying utilities today just to hide from the Middle East conflict? Or is the market finally waking up to the staggering power cost required for AI infrastructure?
Honestly, it's a dual mandate trade. It serves the traditional defensive purpose. You get a steady dividend in a murky macro environment, but it also captures the AI capital expenditure boom. These utility companies are signing massive power agreements with hyperscalers.
So it's basically downside protection with AI upside.
Exactly. And we saw other daytime movers tracking these macro themes too. Ticker APA was up 9.01%, obviously tracking the Brent crude spike.
And SpaceX, ticker SPCX, actually fell 3.14%. The notes attribute that to a technical retracement after its recent IPO rally. Basically, momentum traders just pulling back cautiously.
Yeah, but then you had Datadog, ticker DDOG, jumping 11.48% right in the middle of a defensive tape.
Which is wild. Datadog is cloud monitoring software.
Right.
Why is that booming when everyone is terrified of inflation?
Because cloud observability is a cost efficiency tool. When the macro environment tightens, companies don't ditch the cloud, they just audit their workloads to cut the bloat.
So they buy Datadog to optimize their footprint and lower their monthly computing bills.
Exactly. It's defensive IT spending.
Software bought to enforce austerity. That makes sense. But this entire narrative of austerity and fear completely evaporated the second the 4 p.m. closing bell rang.
Oh, it was a totally different universe after hours. The extended session just divorced itself from the CPI anxiety entirely.
Let's talk about the AI explosion, the second win.
Yep.
Starting with Supermicrocomputer, ticker SMCI. They soared roughly 8.5% after hours. But get this, they actually missed their revenue target.
Right, a fairly significant miss, too.
Yeah, they brought in $11.1 billion versus the expected $11.5 billion. In a fearful daytime market, a miss like that triggers a brutal sell-off. But buyers just flooded in.
Because investors completely ignored the trailing miss, they looked straight at the fiscal year 2027 guidance, which was massive, between $65 billion and $72 billion.
It's like a student throwing a massive party after failing a math test because they just found out they won a full-ride future scholarship.
That is exactly what happened. The revenue miss wasn't from evaporating demand. They literally just can't build the server racks fast enough to satisfy the incoming capital.
Which brings us to the truly mind-blowing part of the post-market data. CoreWeave, ticker CRWV, the essential cloud for AI, they surged about 12% after hours, doubling their year-over-year revenue to $2.58 billion.
But the real story is their backlog.
Yes. They announced a staggering $104 billion backlog. And the sources describe this not just as a financial number, but as a mandate.
Right, which completely silences the critics who thought the AI spending spree was ending.
But I want to push back on this idea of a mandate. I mean, for the listener, $104 billion looks great on a press release. But isn't that just a massive execution risk?
How do you mean?
Well, if there's a global shortage of copper or liquid cooling parts get stuck in customs, doesn't that multi-year backlog instantly become a massive liability of broken promises?
It's a fair question, and the logistical risk is very real. But Wall Street treats this backlog as a mandate because of how the contracts are structured. We're talking about binding agreements backed by sovereign wealth funds and trillion-dollar tech giants.
So the money is essentially ring-fenced.
Exactly. The demand is inelastic. If a sovereign wealth fund decides it needs AI infrastructure for national security, they do not care if the Fed hikes rates by 25 basis points tomorrow. They are building it regardless.
Wow. So that perfectly explains the split personality we saw today. Daytime traders are agonizing over whether a tiny oil spike will force the Fed to squeeze the domestic economy.
Right.
While the after-hours traders are watching sovereign wealth funds deploy hundreds of billions of dollars completely immune to monetary policy.
The AI capital flow has basically insulated itself from the macroeconomic weather.
But the everyday consumer is definitely not insulated. Which brings us to the final and probably most perplexing part of today's deep dive.
The Main Street reality.
Yeah. We have this trillion-dollar AI boom and the Fed's tightening vice, yet there are these weird pockets of resilience on the consumer level.
Right.
Look at COV Group, ticker CAVA. They jumped about 13% after hours on a massive earnings beat.
Same-store sales grew 9%, mostly from strong foot traffic.
Right. So how do we reconcile the dismal jobs data from Friday with consumers enthusiastically lining up to buy premium Mediterranean bowls today?
It's the K-shaped economy playing out in real time.
Break that down for us. What exactly does a K-shaped recovery mean here?
Basically, the economy is splitting into two diverging paths. The top half of the K represents people who own assets, stocks, real estate, or they work in these booming tech sectors. They are experiencing a huge wealth effect.
Right. Their portfolios are at or near all-time highs, so premium fast casual lunch is nothing to them.
Exactly. But the bottom half of the K, the working class relying strictly on hourly wages, they are taking the full brunt of the cost push inflation. Their rent and groceries are up, and the cooling labor market means their bargaining power is totally gone.
So the high-end consumer is spending freely while the working class is getting crushed.
Yeah, the aggregate data looks flat, but underneath, it's a tale of two entirely different economies.
Which makes the NFIB Small Business Index data today so confusing. It hit 99.8, its highest level in a year. If the working class is tapped out and borrowing costs are sky high, how is small business optimism peaking?
It's because many small businesses have successfully pivoted to serve that top half of the K we just talked about.
Oh.
They've managed to pass their higher input costs on to the wealthy consumer, which preserves their profit margins. That's driving the optimism.
But there's a catch.
A massive one, and it circles right back to tomorrow's CPI print. Small businesses rely heavily on floating rate loans from regional banks.
So they are incredibly sensitive to the Fed's rate path.
Hypersensitive. They are optimistic today because they survived the initial inflation shock. But they are operating on a razor's edge. If tomorrow's CPI comes in hot and the Fed signals rates can't be cut, their debt servicing costs will just compound to a breaking point.
Wow. So their optimism is entirely contingent on the Fed actually starting a cutting cycle.
Exactly.
So synthesizing all of this, the macro panic, the AI euphoria, the K-shaped consumer, it paints a picture of an economy undergoing a massive structural reorganization.
It really does, and it leaves us with a pretty provocative thought about the future of investing.
What's that?
Well, if AI infrastructure companies like CoreWeave are securing $100 billion mandates that move completely independent of the Fed or the CPI, are we reaching a historical inflection point?
You mean where the technology sector entirely decouples from the broader economy?
Exactly. If the largest growth engine in history no longer cares about the traditional business cycle, then the old rules of capital allocation might be rendering themselves obsolete in real time.
That is a staggering thought to leave you with. If AI spending isn't reliant on whether the Fed cuts rates, then tomorrow's CPI anxiety might just be irrelevant noise for the companies building the future. Definitely something for you to mull over as you watch the markets open tomorrow.
Absolutely.
Thank you for listening to this episode of the Bulls, Bears, and the Bell podcast. Make sure to hit subscribe on Spotify or your favorite podcast app so you never miss a session. We will catch you on the next deep dive.